that if you've ever wondered whether real estate or the stock market is the better way to build wealth, you're not alone. Because everywhere you look, people are saying different things, and it's honestly confusing. Maybe you're thinking about investing your first $50,000, but you don't want to mess it up or waste years on the wrong choice. So in this video, we're breaking it down with real numbers, real estate versus stocks, so you can see exactly which one can make you more money and which one actually fits you. Alright, let's start with real estate, because this is the one investment almost everyone feels is the safest, and also the one most people don't fully understand. So let's make this real. You've got $50,000 saved up, not millions, not some crazy amount, just $50,000, which is exactly where a lot of people are. Now, instead of putting that money into the stock market, you decide to use it as a down payment on a rental property. Let's say that gets you a $250,000 house. Now pause for a second. You didn't invest $250,000. You invested $50,000, but you control a $250,000 asset. That right there is the power of real estate. This is what people mean when they talk about leverage. The bank is putting up most of the money, but you get the benefit if the property goes up in value. Now here's where it starts getting interesting. Let's say that property grows at just 4% per year. Nothing crazy, just average appreciation in many US markets. That's not 4% on your $50,000. That's 4% on the full $250,000, which means in 1 year, that property goes up by about $10,000. So think about what just happened. You put in $50,000, and in 1 year, you gain $10,000 in value. That's a 20% return. And we haven't even talked about rent yet, because real estate doesn't just grow. It can actually pay you every single month. Let's say you rent this property out. After your mortgage, taxes, insurance, and maintenance, you're left with about $300 a month. Now, $300 might not sound life-changing, but over a year, that's $3,600. And over 10 years, that's $36,000 just in cash flow. And here's the part most people completely overlook. Every single month, your tenant is paying down your loan. So not only is your property going up in value, not only are you getting cash flow, your debt is going down, which means your ownership, your equity, is going up. So even if the market didn't move at all, you'd still be building wealth every single month. Now stack all of this together. You've got appreciation, you've got monthly cash flow, and you've got loan paydown. 3 different ways, all working at the same time, building your net worth. And this is exactly why so many people believe real estate is the ultimate wealth builder. But here's where you need to be careful, because everything we just talked about sounds amazing, and it can be, but it also depends on things going right. The property has to stay rented, expenses can't get out of control, and the market needs to at least hold steady. Because if those things don't happen, those returns can drop fast. And that's the part most people don't talk about. So real estate can be incredibly powerful, but it's not as passive and not as guaranteed as people make it sound. So now the real question is, if real estate has all these advantages, can stocks actually compete with this? Alright, so now let's switch gears and talk about stocks. Because after seeing how powerful real estate can be, the big question is, can the stock market even compete with that? So again, let's keep this simple and real. You take the same $50,000, but this time, instead of buying a property, you invest it into the S&P 500. Now, if you don't know what that is, it's basically a collection of the 500 largest companies in the US. Companies like Apple, Microsoft, Amazon, the backbone of the entire economy. And historically, this index has returned about 8 to 10% per year on average. Now, that might not sound as exciting as real estate leverage, but here's where stocks become incredibly powerful: compounding. Because in the stock market, you're not just earning returns on your money, you're earning returns on your returns. So let's break that down. If you invest $50,000 and earn around 9% per year, after the first year, you're at about $54,500. Now in year 2, you're not earning 9% on $50,000 anymore. You're earning 9% on $54,500. And then the next year, even more. And over time, this starts to snowball. This is how money in the stock market grows quietly, but powerfully. Now let's fast forward. After 10 years, that $50,000 turns into roughly $118,000. And after 15 years, you're looking at around $180,000. And the whole time, you didn't deal with tenants. You didn't fix anything. You didn't take calls at 2 a.m. It just grows. That's the beauty of stocks. They're simple, they're passive, and they're extremely liquid. Meaning, if you ever need your money, you can sell and have cash in a couple of days. Try doing that with a house. Now here's the trade-off. Unlike real estate, you don't have leverage. Your $50,000 $50,000 is just $50,000. And yes, the market goes up over time, but in the short term, it can go down, sometimes fast. And that's where a lot of people panic and make bad decisions. So stocks reward patience and punish emotion. But if you stay consistent and let compounding do its thing, this is one of the simplest ways to build wealth. So now we've seen both sides: real estate with leverage, cash flow, and multiple income streams, and stocks with compounding, simplicity, and true passiveness. But now comes the part that actually matters. When you put them side by side, which one really makes more money? All right, now comes the part that actually matters. We've talked about real estate, we've talked about stocks, but now let's put them head to head. Same starting point, same money, same time. $50,000 invested for 15 years. No opinions, no hype, just numbers. Let's start with stocks. If you take $50,000 and invest it in something like the S&P 500 at around 9% per year, after 15 years, that grows to roughly $180,000. No extra work, no stress, just compounding doing its thing. Now let's look at real estate. Same $50,000 used as a down payment on a $250,000 property. Let's assume 4% appreciation per year, $300 per month cash flow, loan getting paid down over time. After 15 years, that $250,000 property is now worth around $450,000. That's $200,000 in appreciation alone. Add in about $54,000 from cash flow and tens of thousands more from loan paydown. Your total wealth from that one investment can easily cross $300,000 plus. So let's compare this side by side. Stocks, around $180,000. Real estate, potentially $300,000 or more. That's a big difference. And the reason is simple: leverage. In real estate, you're making returns on a much bigger asset, while in stocks, you're only earning on what you invest. But before you say, okay, real estate wins, done, here's the part most people ignore. Those real estate numbers depend on everything going right. The property stays rented, maintenance doesn't eat your profits, and the market actually goes up. If any of those go wrong, your returns can drop fast. Stocks, on the other hand, are way more predictable over long periods. No tenants, no surprises, no active work. So yeah, on paper, real estate can make you more money. But in real life, it's not that simple, because the best investment isn't just about returns. It's about what you can actually handle and stick with for years. If you found this helpful, hit like, subscribe for more real, no-hype money content. Drop a comment. I'd love to hear what you think, and share this with someone who's trying to figure this out.